Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 321 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including government shutdowns, the bear case for stocks, consumer confidence, foreign investors in U.S. stocks, and a will versus a trust. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump right in. Nick, thanks for joining us today. Nick is filling in for Matt, who is busy with other business items. So it's as always, good to have you back, Nick.
Yes, good to be back.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So jumping right into it, getting into the month-to-date and year-to-date performance of the major indices that we track. This data is from YCharts and as of the market close on October 4th, October 3rd. S&P 500 index up 0.4% for the month and up 14.2% for the year. The Dow Jones Industrial Average up 0.8% for the month and up 9.9% for the year. The NASDAQ Composite Index up 0.5% for October and 18% on the year. The Russell 2000 Small Cap Index up 1.6% for the month and up 11.3% for the year. And the Vanguard All World ex United States ETF up 1.8% so far in October and up 26.5% for the year. 3-month Treasury rate at 4.03%, the 2-year Treasury rate at 3.58%, and the 10-year Treasury rate at 4.13%. So moving on to big headlines and current events from the past week. The Fed's preferred measure of inflation, which is core PCE, personal consumption expenditures index, moved up to 2.9% in August, which is the highest level since February and 0.9% above their inflation target of 2%. Despite that, market is still expecting another rate cut later this month on October 29th, and actually expecting one more before the end of the year as well. And lastly, in terms of current events, obviously the government went into shutdown mode last week after Democrats and Republicans could not come to an agreement on a budget for this upcoming year. So as a reminder, the fiscal year for the government ends in September each year. So we are going to get into that a little bit, and it's actually serving as a nice segue because the first thing I have for listeners today, Nick, was about a blog post from Ryan Dietrich titled, "Let's Talk About a Government Shutdown." Mm-hmm. So this was back on September 16th. Ryan posted this, and there's one graphic specifically that I wanted to share. And it goes through, I think for investors, the biggest question is, I'm assuming a government shutdown is a negative thing for the stock market, right? And actually, government shutdowns tend to not really have that big of an effect on stock performance. So the average government shutdown lasts about 8.2 days. And during the shutdown period, S&P 500 averages a positive 0.3%, and it's higher 54.5% of the time. If you fast forward to 12 months after the end of the government shutdown, S&P 500 is up 86.4% of the time for an average return of 12.7%. So to answer that question of how does government shutdowns affect the stock market, my answer is it really doesn't have that big of an effect. And this graphic that will be up on our show notes, that'll also be on the YouTube video if you're watching there. It has who the president was, if Democrats or Republicans controlled the Senate and the House, and there really isn't a rhyme or reason or pattern that shows much effect on the stock market, which I think is a good thing. So before we move on there, Nick, anything you'd like to add?
Yeah, the other thing I'll throw in there is you'll read other items in the headline in the headlines regarding the length of days, how many days the government shut down and how that can impact different areas of the economy and the markets. And so I just wanted to point that out, that in this data, they break that up as well. And so from a market perspective, again, the government was shut down in 95 for 22 days and the market was unchanged. So as you said, there's not a lot of rhyme and reason whenever you look at it just purely from the market lens. So, and I know we've talked about this multiple times throughout the years on the podcast, but this is not something I would get worked up about when it comes to your investments.
Yeah, exactly. And just the last time actually that the government was shut down was back spanning from like the middle to end of December of 2018 until the end of January of 2019. So the government shutdown lasted 34 days. Yep. And during that period, stocks were up 10.3%. So, and I think a lot of that obviously had to do with, December of 2018 was not a very kind month to the markets. There was a big sell-off there. So there was a nice recovery starting in 2019, but just goes to show you that just because the government shut down doesn't mean the stock market needs to fall, although obviously it could. Mm-hmm. Second thing I had was a blog post from JC Peretz titled, "Here's the Bear Case." And this was back on October 2nd. I thought this was good, Nick, because we do tend to lean on the bullishness side most of the time, and that's for obvious reasons, like the market's up on average every 3 out of 4 years. So naturally, most of the time, we're going to be optimistic on the market. But JC gave his opinion on, what the bear side is. And we always like to look at things from the opposite side to kind of confirm our outlook and our thesis, and then also just be aware of where the risks might lie in the market. So he says, historically, these government shutdowns are fantastic for journalists. They get fresh headlines to write, new panels to debate, and endless excuses to fill airtime. They're also a gift to storytellers who need a gloomy hook. Markets can't possibly rally with a shutdown looming, they insist, as if Washington gridlock hasn't been a permanent feature for decades, but here's the reality. The market doesn't care. After digging through all the charts, US, Europe, Asia, Africa, South America, the message is clear. Stocks are trending higher across the globe. If you're hunting for the bear case, it really starts and ends with this chart: consumer discretionary versus consumer staples. When the consumer discretionary versus consumer staples ratio is breaking out to new highs like it is right now, that tells us consumers aren't just surviving, they're thriving. They're buying Teslas, filling up Amazon carts, renovating kitchens with Home Depot runs. This kind of leadership doesn't show up in bear markets. Staples, sure, people have always had to buy toothpaste and soap, but when discretionary leads staples, it is significant. It shows significant confidence, growth, and strength. Forget shutdown gossip, forget scary valuation stories. None of that has predictive power. This is about consumers. This is about leadership. And as long as discretionary keeps leading, it's all systems go for the bulls. If the ratio fails, then we'll have a different conversation. So what this chart is that JC is talking about is it's a relative ratio chart. So it compares directly the consumer staples ETF, ticker symbol XLY, to the consumer staples ETF, XLP. And what you're going to see in this chart is it is breaking out to new all-time highs, meaning that consumer discretionary stocks are outperforming consumer staple stocks, and they really have been since the middle of 2022. So whenever this chart is going up and to the right, that means the more aggressive sector of consumer discretionary is outperforming. And that's a good thing, right, Nick? Matt talks about all the time how I think 3/4 of our economy are made up of consumer spending.
Yeah.
So when these types of names are outperforming, companies that make toilet paper and paper towels and toothbrushes, toothpaste, that's usually an environment where we see stocks doing a pretty good job. So I think JC makes a great point that, if we were to enter a bear market or start to see some weakness in the market, I think it would probably show up in this ratio first. So, I would think that you would need some outperformance from consumer staples relative to consumer discretionary and the rest of the market to see any prolonged weakness.
Yeah, I completely agree. And for those who can access the chart, I highly recommend you take a look at it because it does show a few good examples of what the price movement looks like in a scarier environment. So it shows 2022, for example, where the market was under quite a bit of pressure throughout the year, and you can see the chart is showing exactly what we would expect it to show, where staples are leading. And again, with the pullback earlier this year, bottoming sometime in April, same thing, you can kind of see that. So what JC Peretz is saying here is looking at the chart where we are, all-time highs, it's clearly trending higher, the ratio that is towards discretionary. So all systems go. This is a good thing. So again, scary headlines, and I have another piece about this as well, which is funny. We're really covering it from all angles regarding the government shutdown. But again, I wouldn't get over my skis with all the scary headlines right now.
Yeah, agreed. Last thing I had, Nick, was a quote from Joel Tillinghast, and Joel said, "The best investors I've seen all have an above average ability to change their mind." And I think that this is something in investing and just in life in general that people, for whatever reason, are scared to change their opinion on certain things for the fear of getting shamed that they were wrong, or the fear that, well, you're a flip-flopper. You said this 5 years ago and you're singing a different tune now in the present. And especially in investing, this is extremely important to understand when you are wrong or when you made a wrong decision. So Matt and I talked about the other day on a podcast, opportunity cost, and it's investing in one thing that may be losing money, and you're not only losing money, but you're foregoing investing that money in something else that is going up, right? So this industry, I'm sure you can attest to this, is very humbling. And to be successful, you need to understand when you're wrong and understand that relatively quickly so you don't do yourself, or in our case, your clients, more harm. So I thought this was interesting and wanted to share it with you, Nick, and then our clients and whoever else who listens to this show.
Yeah, it's a great quote. I don't have anything to add there. Opportunity cost is always a big thing. We definitely talk with clients about that, and I'm sure that topic will continue to come up on many a podcast because it's very important.
Yeah, agreed. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
So the first thing I have for listeners today is on consumer confidence relative to consumer spending. So this is a piece from Charlie Bilello. It's research. It's a little bit older. He released this on 9/23. He says, we've never seen a disconnect this wide between what the U.S. consumer is saying and what they're doing. The University of Michigan Consumer Sentiment Index has moved down to 55, a reading below 99% of historical data points going back to 1952. At the same time, retail sales grew 4.8% over the last year, outpacing inflation by 1.8%. So really quick, what is the University of Michigan Consumer Sentiment Index? It is basically an index it's a survey data. They send it out to different market participants and try to gauge how people feel about the economy, about their job, about employment, et cetera, the markets. And then they build it into an index, and the lower it is, obviously the lower sentiment is. So you can see that there's a chart here, and it bounced a little bit earlier this year, but we've been moving in a lower direction. But at the same time, if you look at the chart for U.S. retail sales, it's pretty much doing the exact opposite of what sentiment is saying. So people are saying, hey, I'm really nervous about the economy. I'm really nervous about my job. I'm worried about the stock market. But they're still spending their money. They're still going out and buying concert tickets and golfing and doing things to stimulate the economy. So this is really what Charlie's just pointing out, is that, despite some of the negative sentiment data you might be seeing or reading about, until the hard data, there's those differences, and I've talked about that in the past, of the soft data and the hard data. And as long as the hard data is coming in and showing that the consumer is continuing to spend, that's not bearish.
Yeah, and I would add to this, I actually just saw a piece of research earlier this morning. I can't remember who it was from, but anyways, when the University of Michigan Consumer Sentiment Index actually drops below 56, which is right now it's right around 55, the forward returns in the S&P 500 are actually pretty good. So it's another one of those things where it kind of is a contrarian indicator, is when everyone is getting super pessimistic on the economy or the stock market, then stocks tend to do well, and vice versa. So I would actually look at this as a positive data point, with consumer sentiment being weak, but then with retail spending being strong. I think that's a really kind of nice mix for future stock performance. Obviously, anything can happen, but what we've seen in the past is this tends to be a good thing for the market.
Yeah, absolutely agree. Sometimes there are moments in the market where you kind of have to grit your teeth and buy.
That's right. As Matt always likes to say.
Yeah. So the second thing that jumped out to me, this was last week on the 26th, was an article about foreigners snapping up U.S. stocks. I think I talked about this maybe 6 months ago, and I know the media has talked about this at length, and people have probably seen headlines similar to this Bloomberg headline that I saw on Wall Street Journal or CNBC. And it was about how, as the administration unleashed the trade wars, people were concerned that foreign buyers would boycott American financial products, i.e. not supporting the U.S. equity markets. There was talks about different taxes for foreign investors and how that would work out, and there was some legitimate concern there. And this article was just checking back in on that, and we've actually seen the opposite. So there's a chart here that just shows U.S. stocks owned by foreign investors. It goes all the way back to August of 2024, and it has continued to just hit record highs. It did blip a little bit through April, as we would expect. That's just the market pulling back. But since April, it's continued to move up to all-time highs. So again, that goes to show you what forecasting and what a lot of the the fear mongering, so to speak, in the news can happen. Because I actually specifically remember, and I don't know off the top of my head what podcast it was, but I remember looking at a chart and wondering, how will this impact foreign investment? And maybe that's why we're seeing some of the outperformance in international stocks, right? Earlier this year, go back to January, even beginning of last year a little bit. Hey, maybe that's one of the stories. And well, that's not the case, clearly. So
yeah,
I don't know if you have any thoughts on that.
We all saw a bunch of headlines that, tariffs are going to scare off foreign investors from buying U.S. debt and U.S. stocks. And again, I'm giving a lot of credit to Matt in this podcast, but he was one of the people that said early on, American companies are still the best companies in the world from what they produce and from a financial standpoint. So he was like, until that changes, why would foreign investment or any investment in the U.S. change for that matter? At least if you're someone who's smart and wants to make money, right? You're not going to take your money out just because of your feelings or your thoughts about something. And like we always say, we can't make investment decisions based off of news headlines, because I'm sure there's a lot of people that did that back in April, and they're probably kicking themselves right now. So Absolutely. This is a perfect recent example of why we don't do that.
Mm-hmm. Yeah, just to follow up on that as well, it gets down to earnings growth as well. That was another thing that we all three of us talked about a lot earlier in the year was the earnings growth numbers of U.S. companies have been historically much higher than Europe, which is why U.S. stocks have outperformed for such a long time until the beginning of this year. So the last piece I have is just a little bit more on the government shutdowns. This is a little bit of history. Picked this up again from Bloomberg on 9/30, so the end of the quarter here. And it just took a little bit of a historical dive into what actually happens with government shutdowns from a market perspective. And the main takeaway that they came away with is that you can expect a little bit of dollar weakness. We talked about the stock market earlier. The stock market typically takes this in stride, but you do tend to see a little bit of dollar weakness. Now, I mean quite literally a little bit, a couple percent, 1-2%. It's not like the dollar's going to fall off a cliff. That's not what we're saying. That's really the biggest thing from the shutdown is the longer the shutdown, the more you can expect a little bit of weakness in the dollar, and the further that weakness will go. Again, maybe instead of 0.5%, it'll be 2%. Those are the kinds of numbers we're talking about. So nothing that I think the average investor, particularly people in a long-term horizon, need to worry about. There's a chart that you can check out here, and it just shows that shutdowns leave the dollar a little bit on the back foot, and they show the 2013 shutdown, 2018, and then the one that we talked about that kind of was the end of 2018 into 2019. That longer one that was like 30 days. Yeah. It shows that as well, and you can kind of see how the dollar, the longer it goes, it tends to trend a little bit lower. But again, we're not talking crazy numbers here that need to give anybody worry. It's more just providing you with that little bit of tidbit of, okay, well, what does happen, from an investments perspective that might be of interest to you. That's one thing that is definitely a correlation.
Yeah, for sure. And like you said, we saw this back with Trump in 2018, and his trade policies combined with some other things, I think kind of promote a weaker dollar, and we saw this once, and we're seeing it again, right? So,
exactly.
So this is something that's not surprising, and I think it's important to note, a big move for the dollar is like, 1%, 2%, 3%. Like that's a pretty significant move when we're talking about a currency like this. So. Like you said, nothing to be too concerned about. I mean, the dollar has been falling all year.
Right. Yeah.
So
the market's still going higher, and I'm sure
exactly
consumers, for the most part, where does that hit you? I mean, it's going to hit you with some international travel, and it's going to hit you in some areas of your wallet that you can't really see necessarily. But it's not going to change your plans. I don't think for most people.
No.
Like even your travel plans. If you're traveling abroad, it's not like you're going to change your trip. Maybe you book it a little differently, right? Maybe maybe you go out and buy the hotels now or something like
Right.
that. But even still, if it's me, I'm just going to continue to live my life and not stress about that too much.
Yeah, exactly. Because we could get to tomorrow and government shutdown ends and dollar rallies 1 to 3% over the next couple of weeks, and then we're right back to where we started before the shutdown.
Exactly.
So, nothing in our opinions to be too concerned about. Well, thank you for hopping in and joining me today, Nick. It was a treat as always.
Thanks for having me.
Yeah, absolutely. So we're going to transition to Taylor Ledbetter for our financial planning topic of the week. Taylor is going to be talking about estate planning and specifically wills versus trusts. So Taylor, welcome back.
Yeah, it's good to be back. I wanted to talk about really the key differences between wills and trusts today, because I know it's a question that I get a lot from clients. So just wanted to talk about maybe when you need both of them or one over the other.
Great.
So I think most people will know the general idea of a will. It's just a legal document that outlines how you want your assets dispersed after passing. I think one of the most important features of a will is that you can appoint guardians for minor children. So anybody who has kids, I definitely think a will is a necessity. Whereas a trust, it's more of a legal arrangement where you transfer assets into a trust document, and then a trustee manages those assets for the beneficiaries. Trust can be a lot more detailed towards your specific goals. But if we want to talk about more of the kind of minute differences between the two, number one, a will takes effect at death, whereas a trust takes effect upon creation. A will also goes through probate, which I think surprises some people, whereas a trust does not go through probate. A will is also public record, so any friends or family can view what's in that document and go to the court system and maybe fight for what they want, whereas a trust is a completely private legal arrangement. Something else is that a will, if for some reason you were to become incapacitated, just unable to make decisions for yourself, a will doesn't really have any control over that, whereas a trust does. So somebody could help manage those assets if you weren't able to make decisions for yourself. I mentioned earlier that in a will you can name guardians for your kids, but a trust you cannot. So I think for the most part, everybody probably needs a will, and then a trust would be for specific individuals.
Yeah, the best way I like to explain a trust, to try to keep it as simplistic as possible, is think of it as like a see-through box that you put all of your things in, right? You put in your non-retirement accounts, your bank accounts, your property, your primary home or a vacation home or something, and it's a lot harder for people to take the top off of that box and get their hands in there other than you and your family and the beneficiaries that you designate that money for. And it just gives you more control over how those assets go when you're no longer here, right? Mm-hmm. And the big thing, like you said, with the will is that stuff goes through probate. So if you have your house or your possessions in your will saying that I'm going to leave it to my 3 kids, guess what? That's going to go through the probate process. Different than a trust, and then different than having a retirement account, for example, that has a listed beneficiary. That account will not go through probate. But it is important to know that depending on how backed up the probate court is, that process can take anywhere from 18, sometimes 24 months. If you have a relatively simple estate and, don't have that many possessions, it could be quicker than that. But if it's a more complex situation, you or your family need to prepare for more of a long, drawn out process. And like you said, a big downfall of probate is that is a completely public process.
Mm-hmm. Yeah, and to add on to what you're saying, if you have beneficiaries on retirement accounts, but you also have your retirement accounts and your will, the beneficiary designations kind of supersede the will. So if you have somebody named completely different in the will than who's actually a beneficiary, the beneficiary on your account kind of takes precedent.
Yeah, great point.
Over the will. So I think a will really just makes sense, kind of like you were saying earlier, if you have a very straightforward estate, you're not a business owner, you don't have rental properties, things like that. And if you're also looking for something a little more cost effective. I think the main advantage with the trust and why you would want to use a trust is if you are worried how your assets are going to be spent in the next generation, because again, you can get very specific. You can allow your beneficiaries to maybe get income at age 30 or 40 or only spend it on very specific things. A couple other reasons I think you would get a trust that we haven't mentioned quite yet is if you do have a family member or dependent who is special needs. Because once you're gone, that special needs dependent would hopefully be getting something from Social Security. And if you leave assets in a trust to that person, it doesn't affect their Social Security.
Right. Yeah, and that's a big one. There are companies out there that specialize in special needs trust or trustees for special needs trust, and that's probably one of the more popular uses of a vehicle like this. But obviously, if you have a child, for example, who has special needs, you want to make sure that they're going to be taken care of when you're no longer there. So yeah, highly recommend if someone is listening to this and they're in that situation, that they reach out to someone to inquire about that, because it is a very, very powerful tool to be able to take care of that person who needs it.
Mm-hmm. Yeah, absolutely. One other point that we haven't mentioned just yet, which I don't think this would affect too many people right now, but a trust can also be utilized if you're worried about just your federal estate tax after you pass, which right now in 2025, if you're married, you can have just right under $28 million in your estate before taxation kicks in. So that's a very high limit. It's probably not going to affect most people, but for individuals who would maybe be over that limit, a trust would help avoid any taxation.
Yeah, great point. And then a lot of people bring up like the creditor aspect of it. So, when you pass away and let's say you have $20,000 in credit card debt or whatever, it's a lot harder for creditors to go after people if most of their assets are in a trust, whether, rather than if you just have a will. That's kind of free game, right?
Mm-hmm. Yeah, exactly. But yeah, again, like we were saying earlier, if maybe you are debt-free or you just don't have a lot to take from, then a will would just make more sense for you.
Yeah, for sure. Well, thank you, Taylor, for bringing that up. It's actually good timing. We, down the line in my family, there have been some conversations about, some of this stuff and if people need a will or if a trust is something that they need instead. So hopefully this was useful for everybody listening. So thanks for coming on and discussing that.
Yeah, of course.
And thank you, everyone, for listening to episode 321 of the Independent Advisors Podcast. We will be back with you next week for episode 322.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.